Hello and welcome to this week's first update of Prop Desk Weekly. My name is Alejandro Zambrano and I'm a seasoned trader and economist. And on behalf of Think Capital, we will take a look at some of the events that are moving the markets. Before we start though, as always, I need to stress that trading financial markets unfortunately is high risk and we may lose all of our invested money. As well, I'm going to provide my outlook on the markets. But as always, do your own research. Okay, good. So what's going on? Let's talk about what's happening right now. So U.S. inflation, which is out with, we saw growth of 0.5% on the month, which was higher than the 0.4 anticipated and higher than the 0.3 seen last month. On an annual basis, we're looking at an increase of 3%. And this is really interesting. And I think it's the reason why gold prices are pushing to the upside, as well the reason why I think we can keep pushing to the upside. So that's the reason why I think Euro-USD is going to drop much lower. And it could also be one of the reasons why we see a bit of pain in stock markets. We'll take a look at the charts in a couple of minutes, but right now let's just focus what we have at hand. So let me explain my thesis here. So we have the non-farm payrolls out last Friday, right? So if you look at that, the outcome was not as good as anticipated, but the prior reading was revised to the upside. It was closer to some 300 or so instead of 256. So if you look at the actual non-farm payrolls over both months, we had some good numbers. Now, what's interesting is that earnings, they actually rose not by they rose all the way by 0.5, okay? Increased by 0.5, so higher than the 0.3 anticipated. And that was the highest reading we've seen in quite a while as well. And the unemployment rate did not remain steady at 4.1%. It actually went down to 4. So you have better than expected unemployment rate and wage growth picking up to the upside. Now, yesterday, the head of the US Central Bank, Powell, he was speaking in front of the Senate, as he does 2 times a year. And I was looking for him to tell us what he would say about inflation and the economy. But he said this: the labor market is no longer a source of significant inflationary pressures. Come on, wage growth just increased with 0.5%. We have deportations on the way in the US as well, where people that before would work on, say, farms and construction are no longer showing up to work. So realistically, and if you look at the data, it is driving inflation. He also said no need to rush policy adjustments. Well, if you look at the inflation reading today, again, in at 0.5%, which was much higher than expected. So you have inflation at 3% annually, you have unemployment rate at 4%, and you have strong wage growth. Think about that for a minute. That is a central bank that would normally raise interest rates. Why don't they want to raise interest rates? Well, Trump just recently, just an hour ago, so put a message out that he wants to see lower interest rates. And what is he doing? Well, he's firing a lot of government workers and officials, and realistically, the Fed does not want to get into the sights of Trump, not much more than they need to. So they're probably going to keep rates unchanged for a while. And that's the reason why I think people are buying gold, because they think that inflation is going to pick up much more in the US and the central bank is not going to do nothing about it. So that's really my thesis here in terms of gold. And let's take a look at the charts in a minute, but I still think we're going to see a lower Euro-USD. I still think we're going to trade below parity. Let me explain why I think so. Well, the reason for it is that the EU is realistically going to be targeted next by the Trump administration, right? I'm talking about tariffs. As well, China, those tariffs that were increased remain in place. And I think in the case of both the EU and China, there's not probably going to be a quick resolution, as we saw with Canada and Mexico. So I think that's a good reason to anticipate Euro-USD to trade even lower. And then again, inflation in the euro area increased slightly from 2.4% annually to 2.5%. We saw that last week as well. But what's interesting is that Germany is in a recession, and the whole euro area as a whole is having very poor economic growth. So with that in mind, realistically, they're going to keep on cutting rates in the euro area. Well, in the US, they're probably going to hold rates steady for a while and then possibly at the later stage, probably increase them. So what else can we learn? And I find this also really intriguing and could potentially be used as a setup in maybe something like the Nasdaq 100. So let me explain what I mean by that and why I think so. Well, if you look here, there was a 48-hour trade war, right? From sort of Saturday, tariffs introduced against Canada and Mexico, and then by Monday, everything was sorted. And one might think that, hey, look, Canada and Mexico had to make huge sacrifices to be able to have these deals, but in reality, they didn't. You see, Canada said they're gonna make 1.3 billion in investments in border defense and migration, but they had already announced that back in December, so it was old news. But if you go on X, you look at what the Prime Minister of Canada said, he frames it nicely, makes it look like it's actually something new, but it wasn't. The only thing that's really new is those 10,000 troops. The other bit as well is that in the case of Canada and Mexico, they have already had troops along the border. In fact, in 2019, Trump made them have about 15,000 troops. Now they're going to add 10. So it's literally less troops than they had before, and something they have tried before. And as far as I understand it, hasn't really solved the problem, because otherwise you wouldn't be having this situation. And I think what's happening here is that the US didn't really gain too much. There was a lot of rhetoric and also these measurements, but at the end they fold very, very easily. And I think this is good and bad. For us as traders, a bit difficult, because if you were like me, I was bullish the dollar CAD, and unfortunately I got stopped out just before the weekend, so I wasn't long. But imagine if I was still long, and then weekend we start trading again and you're up nicely, I would have kept that position, because normally these trade wars take time, weeks, months to get sorted. But here it got sorted really, really quickly. And you know what? It reminds me of last time Trump was the president. I remember I was long oil. I was up for a couple of days because I like to swing trade. And then he said something about Saudi Arabia, them producing more oil, and prices collapsed, and I got stopped out. So I think what I remember from then and what I can see right now is that we need to be very quick. We need to be very nimble. So if something like this happens, I will book half of the positions before hit TP, and if not the whole thing, and then just getting ready to enter at new levels. Just because it's a lot of fighting, you know, it's like, you know, these pub brawls, like everybody screaming and fighting, arguing with each other, and then it's like, okay, you know, when it's time to actually fight, they both fold really easily. So I found this super interesting, and I think we need to bear that in mind. But yeah, that's what's happening on a macroeconomic perspective. What can you look forward to this week? Well, there's not much really. US retail sales on Friday, I don't really think it matters too much, but we have it there. Next week, if you want to trade the Australian dollar, then that's your opportunity. So on Tuesday, the central bank is probably going to cut rates from 4.35% to 4.10%. And why would they do this? Well, GDP growth is weak at 0.3%. Inflation is sort of back towards target. They have a target between 2 and 3%. We're back now at 2.4%. And the unemployment rate is stable around 4%. So they're not necessarily being too aggressive here, but if they want to cut a bit, it makes a lot of sense. Like you have interest rate at 4.35% and then inflation at 2.4%. So obviously real rates, the real rate is positive here, which would slow down the economy further. Now here's another one. So the RBA, they're anticipated to keep rates unchanged at 4.25%. Now I find that a bit surprising. Maybe these forecasts is going to update, but the reason why I say so is that according to Trading Economics, GDP was negative 1% and inflation was at 2.2%. So here you're definitely close to inflation and target, and you have your GDP growth at negative, and the unemployment rate is sort of at 5.1%. It's not really moving anywhere, but it's obviously a bit higher than we've seen last. So that could be something. And then on Wednesday as well, Wednesday morning, you have 2.5% UK inflation figures. Obviously, next week I'll see you here on the update, and we'll talk more about whatever's going to happen next. but this is what you have ahead of you for the next couple of days. Let's take a look now at some of the charts, just to give you an idea of what I'm looking at. So here you're looking at Euro USD, and I've been bearish for a while. Since we're down here, I said we could probably push to the upside, and here people are going to probably short sell with stops on the other side, and we pushed lower, which made a lot of sense, and now we push a little bit lower again. And this, from a swing trader's perspective, this whole area is a level where I will be bearish. So as long as trade below 104.53, I think we can go down to 102, 101, and then maybe parity. The only problem is that you have a lot of people like me thinking that this is going to happen, and you have a lot of people thinking that this is it. But hey guys, deportations, high wage growth, I've seen it before, and an economy that's going really strong. And then if they do tax cuts, more deregulation, they need to expand the labor force. But it's not easy. Like in the UK, they try to do the same thing. Some people got jobs, but people that were unemployed before didn't necessarily get jobs just after Brexit kicked in. In fact, a lot of the shops closed down. Not saying the same thing is going to happen here, because the trade war against Mexico and Canada was averted. But they need to do something to get these long-term unemployed people into the labor force. We talked about the AUD USD. So this is an old chart I looked like a long time ago. I've been bearish since a while. As you can see here, I was stopped out. If we look at this today, if we remove all of this, I would say we're trading within a range. It's not the best. I don't really like this. In fact, we're trading sideways since December 19th. But I would say as long as you're below these levels, I would say push to the downside. And this is, I found quite interesting. This is the Nasdaq 100. So the reason I found this quite interesting is because in terms of trade wars, the biggest disaster for the US economy would have been the trade war against Canada and the trade wars against Mexico. That has now been paused or delayed for 30 days. Realistically, they're going to find some sort of solution. So then you sort of got rid of the most critical. They still have these tariffs on China, which you already had before, just increase them a bit. And the Chinese are clever as well, because what they're doing, they don't have too much direct business between the US and in China right now. Rather, the Chinese companies are setting up shop elsewhere, like Mexico. And that way, when you import it, it looks like it's from Mexico. And it probably most of it is being made in Mexico. But at the end, there's no much direct business, so it's less of an impact there. So with that sort of problems out of the way, we're looking at quite an interesting rectangle pattern here, where if we would break above 21,972, we could potentially lift to the upside. You might say, well, hey, come on, inflation is too high, the Fed would be forced to do something about it. Well, the Fed is going to have another opportunity today, the head of the central bank, to speak. Let's see what he says. I don't think he's going to say too much. But did you know that stock indices are actually a quite okay tool for hedging against inflation as well? So if people think that inflation is going to be allowed to go crazy, and then this could potentially be an interesting opportunity. I prefer this rather than buying the dip. So how about gold then? So this is gold. This is an old setup. I haven't updated this as well. If you look here at gold, I think we bottomed out here in the space where we just saw. So if you look at this, I would say something like that, and just being bullish, I would say above 2,847. So something like this, down and then up, but realistically, as long as you're above here, we're probably going to go higher. Why? Well, as I just said before, the Fed doesn't want to do nothing about inflation right now. They're sort of laying low, and you know, if it's going to be like this, people want to protect themselves, and that's where I think gold can become handy. That's it for today. We'll be back next week, same time here on